Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. We're now less than 2 weeks away from a potentially multi-billion-dollar strike impacting General Motors, Ford, and Stellantis. This is the first labor unrest hitting the big Detroit automakers since 2019, and it comes at a precarious time for the industry, as a lot of upstarts are starting to gain a significant market share, namely Tesla, but there are a number of other companies. And this strike could both increase costs and actually reduce production at a time when these companies need to be producing as many vehicles as they can. So I want to dig into exactly what workers are looking for and what to think about this as an investor. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to go over first what the news reporting is about the strike right now. This is from CNN Business, but it highlights a lot of the content that we know. First of all, this strike has been authorized. So we know that has happened. And all three automakers, their current contract is going to expire at the end of the day on September 14th. So as I'm recording, that's 2 weeks from now. They could potentially all go on strike at that time. What are workers looking for? The current reports are that they're looking for up to a 46% increase in pay, a 32-hour work week, and a return to traditional pensions. So not 401ks, which are defined contribution, but defined benefits. These pensions are actually what helped bankrupt a lot of the automakers during the financial crisis. So that's one thing that might be a real sticking point in these negotiations. There are a couple of other interesting things in here. Wants to protect against job losses. One of the things with building electric vehicles is that it doesn't take as much manpower. So there could be potential job losses just from an efficiency standpoint by going to electric vehicles. And a lot of these companies have made joint ventures with their battery partners or other partners that aren't necessarily covered under UAW contracts. So they want to start getting those people under UAW contracts as well. Analysts have predicted that this could cost these three auto companies alone about $5 billion in 10-day strike. Now, we don't know exactly what that financial impact will be, but I do think the impact of the pandemic and what we've seen coming out of it is really telling, because one of the things that we've seen was that the reduction in supply during the pandemic actually led to higher profits for a lot of these automakers. So they weren't making as many vehicles, but they were making much more money per vehicle simply because there was less supply. Now, could that be the case if there's a prolonged strike? Supply is not quite the same problem as it was a year or so ago, as automakers have started to produce more vehicles, but margins have stayed relatively high. So what companies are doing right now is they're trying to fill their channels as much as they can before a potential strike, so that even if it lasts a month or so, it's not going to have a huge detrimental impact on their business. Now, that isn't to say it's not going to have a negative impact. What I'm going to be watching from an ongoing basis is how does this increase operating costs and flexibility for these companies in the future? We know that there's a lot of changes going on in the auto space today, not only the move to electric vehicles, but also the move to autonomous technology. What do companies have to agree to get people back to work? Is that something like pensions, which is an ongoing long-term liability? Is it something like guaranteed jobs or shorter work weeks? The details are going to be really important here. And remember, we are in an environment where unemployment is relatively low. So workers do have a lot of negotiating power. This is one of those things that could have a big impact on automakers and actually accelerate the transition to the market moving to some of their competitors. That's just the right reality of the dynamic right now. And if you're an investor in General Motors, Ford, or Stellantis, it's something you need to keep in mind. I own shares of GM, and that's the one I'm going to be watching specifically. So check back here at Asymmetric Investing for the latest on if a strike does happen and what a potential agreement means as well. Don't forget, thanks for watching, everybody. See you here next time.